become a fellow of the Royal Institution when I was 33. And when I had my last proper job, so to speak, I was the managing partner of the West End office of a well-respected firm of chartered surveyors in the West End of London.
Fantastic. Okay. Well, that's just a brief introduction as to what Peter's all about, and I'm sure that Peter's got a lot of great content to share with us all. And just so that you know, we're here to help everyone, from regardless of what your experience is, whether you're just starting out, which can be the loneliest thing in property ever, to the more experienced investors that are just looking for the right way, or just a bit of realization. Or I would say that myself as a landlord, I've got 500 tenants, and sometimes I have to sit back and reflect. And I actually speak to Peter, and Peter's a very level-headed young man, and he puts me gives me a reality check. So sometimes it's always good to listen to someone who's got a different experience. So tonight we're going to be talking to Peter, so I'm hoping that you're going to really enjoy it. And if there are any questions, please feel free to ask, and we'll see what we can do to answer them. So moving forward then, Peter, what can you tell us?
Well, Arsh, I'm guessing that there's probably three sort of different types of people who are listening tonight. There's those people who'd like to buy a few buy-to-let properties to supplement their pension. There's probably some listening who'd like to buy a few properties to supplement their current income. But maybe there's a few people listening who'd like to be a bit more aggressive than that, and who'd like to build a portfolio of buy-to-let properties so that they can be financially free. But whichever camp you fall into tonight, then hopefully I'm going to be able to give you some content to help you with that. But before we go any further, I just want to tell you something which I've realised and discovered and learned along the way in my 30 years in property. And that is, the secret to being a successful buy-to-let investor is buying the right property. I'm going to say that again. The secret to being a successful buy-to-let investor is buying the right property. Now, I know that that might sound very obvious, but to be honest with you, I've noticed that quite a few people actually don't get that right. But before we go any further, Arsh, I'm just going to tell everybody who this webinar is for, if that's okay.
Sure.
So it's basically for anybody who wants to get into buy-to-let and who wants to get off to the best possible start. It's for anybody who's already started, but who's perhaps stalled or who's struggling to hit their financial goals and targets in property. It's for anybody who's doing okay, but who wants to do it better. It's for anybody who wants to go into buy-to-let confident of the fact they're not going to run out of money before they achieve their financial and property goals. But just to be absolutely clear, it's not for people who are extremely experienced and successful and who are happy with their progress. So, we move on perhaps to talk about what we're going to be talking about tonight, Ash.
Yeah, sure.
We're going to be talking about what do you want from property, what's the right strategy to get you what you want, how to find the right property for the strategy, how do we buy and finance our property, what we can do with our property to help us make real money, and how do we finance that property, and what do we do then? And really, the ideal in buy-to-let, which we should be aiming for, is buying the right property so we can pull all of our money back out and then go and buy another one. And obviously if we can do that every single time, then we can really go on for as long as we like and choose how many or how few properties we want to buy. Hopefully how many. So, one thing which I have noticed is that surprisingly, many buy-to-let investors do get it wrong. So I think it'd be worth just sort of talking about that before we go any further, Arsh.
Yep, sure.
Well, I do some mentoring, and over the years I've realised that when I've been talking to my mentees, and not just my mentees actually, but also other investors who I meet along the way, that although we all think we know how to do it, very few of us do it very well. And by it I mean buy-to-let and buying property. In fact, I was meeting with one of my mentees a few weeks ago, Ash, and he said that before our meeting, he'd been talking to his father-in-law, and he'd told his father-in-law that he was coming to meet me, and his father-in-law had said to him, well, why bother with that? Why don't you just go out and buy a property? And way a lot of us think, and that's what a lot of us do. We just go out and we buy a property. And another problem which I see quite a lot, Arsh, is that investors run out of money. They can be very fast out of the tracks and they can be very enthusiastic, but unfortunately, after a little while of buying, they run out of money and that brings them to a complete stop. Whereas I think that if you're actually following a proper, systematic way of buying property, then you'd be able to control that, and it'd be down to the investor to choose how many properties they can buy, confident, but by doing it in the proper, systematic way, that they wouldn't necessarily run out of money. And then another thing which I come across, and I know this all sounds very negative, but the reason why I'm saying this is just so that we can bear this in mind and actually turn it all around and look at how to go forward properly in a moment. But another thing I come across, Arsh, is that I've met investors who aren't even sure why they own the properties that they own. For example, I might sit down with them and look at their spreadsheet with them, and they'll show me a property, and I'll say, well, why have you bought that property? And they'll say, well, I bought it for cash flow. And I'll look at the figures and think, well, there's no way that property is ever really going to give a very good cash flow or a very good income. Or it may be that they tell me that they've bought it for capital gains. But again, if you look at the property and the way that they've bought it and the terms upon which they've bought it, it's probably very unlikely that they're going to make that much from it. They would have been better off perhaps buying another property elsewhere where they would have had much more prospect of capital gains and price rises. And then another thing which I come across sometimes is the enthusiasm of a new investor who'll go down to the estate agents on a Saturday morning, and they'll be stood there looking at the pictures and the details of the properties in the window on a Saturday morning. And they may see one which they quite like. And it may be that they like it because it's a bit like their own house, or it's a house just down the street which they think will be easy to manage. And they go into the estate agent, they say, can I have the details of that one in the window, please? And they'll look at it, and then perhaps they'll make an appointment to go and view it. And then they'll say, you know what, I'm going to buy this property. And so they make an offer, and if they're feeling really sophisticated, they may offer, say, 10% below the asking price. And if they negotiate really well, they may get it at 5% below the asking price. And then they feel that they've got themselves a real bargain. And I don't know if you can relate to that, Arsh, but that's certainly how I started when I began in buy-to-let. But I've realised that it's much better to have a far more systematic way to buy, especially if you want to put together a portfolio which is going to give you a decent return. But the truth is, in principle, anybody can go out and buy a property, and I guess that if you buy a property and wait long enough, you're probably going to make some money out of it. And that's the way quite a few people do buy-to-let. They'll buy a property, not really thinking about the investment fundamentals, and maybe over time the property will come good because, as we know, the market is cyclical and, property prices are going to go up at some point. But it's not the best way of doing it. But you know what, Arsh? I'm not knocking that, because the mere fact that those people have taken action actually elevates them probably into the top 5% of the population. But the truth is that, sadly, good intentions don't guarantee the right results, and they don't produce the maximum returns. So, as I say, I'm not being critical. I've made all the mistakes there are to make, and the system I use for buying property really came about very much by trial and error. There's nothing clever on my part. I was just very fortunate that when I started off, I came across a system which helped me to buy property. So if anybody's listening who's made any mistakes or feel that they haven't got off to the best possible start, then I'd say don't worry about that, because now's the time where you can review what you've been doing, and going forward you can perhaps do things in a more predetermined way. As I said at the beginning, the secret to being a success in buy-to-let is buying the right property. And the point is that when we adopt a system, we can guarantee that we're buying the properties that we need to achieve the results that we want. And that's going to make a massive difference. Little things that we do now today in terms of returns and making sure we buy the right property at the right price on the right terms is going to make a massive difference 15, 20 years down the line. So the key thing, I think, which I want to get across tonight, Arsh, is that to buy the right property, we need to obviously know what we're doing, but we need to have some kind of a plan behind that and stick to the plan. And part of that is becoming proficient in some of the basics of property investing. Because once you've become proficient at the basics, then you can master your subject and you can move on confident. In the future, you'll be able to use these very simple key techniques, tools, and strategies, which are going to make such a big difference to your investing business. So, moving on, Arsh, I think the first question we want to answer is, what do you want from property? Now, I realise that might sound like a very strange question. I mentioned earlier that I meet investors who aren't actually sure why they own a particular property, saying that they may own a property which they think is going to give them cash flow, but it probably isn't the best property to buy that cash flow. Or they will.
Sorry, Peter. Hi, Peter. Hi, Peter. Sorry, I think we've got a bad. We've got a bad connection because from what I can understand from some of the people saying that some of your connection's quite bad. So, what where we lost you is what you want from property.
Yeah, that's what we're just about to start. Yeah, is that better, Arsh? Can you hear me now?
It is indeed. Yes, thank you.
Yeah. Okay. Well, I was saying that sometimes I come across investors and they're not quite sure why that they own a particular property. They bought it for income, but it's not ever going to cash flow very well. Or they might have bought for capital gains, but it's probably not going to be one of the best properties for actually achieving capital gains. And I'll find quite often that they're not really sure why they even bought the property. It could be that they bought it because it was just down the road, and so they thought it'd be easy to manage. Or maybe they bought it off a friend or a relative, or maybe even perhaps somebody like their managing agent was selling another client's property, and so they were offered it and they decided to buy it. So I think the key thing before anybody starts in buy-to-let is to be absolutely sure that they know what they want to achieve from property. So when I sit down with particularly new investors, I'll say, what is it you want to achieve from property? And the answers I can get can often be very vague, such as, well, I'd like to be a success in property, or I'd like an income in property, or I'd like to own a few properties, or I'd like to have a few so that I've got something to look forward to in the future. And it can all be a bit vague and wishy-washy. And the problem is that if you're not really sure what you're trying to achieve, then buying any property will do, which, as we've already seen, happens too often and isn't the best way to invest in property. So in my opinion, an investor needs to know exactly what they're trying to achieve and why, which, if you think about it, isn't unreasonable because we're going to be talking about spending fairly large sums of money, so we don't want to be doing that on a whim. We need to know exactly what we're trying to achieve. And when we know that, we can then express that as clear, focused, written goals. Even better is if we can then put precise numbers on those goals, so that we know exactly what we're trying to achieve in financial terms. The other thing is that we need to be very realistic in our time frames. Many investors who I meet want to achieve far too much too quickly. They want to produce passive income from tomorrow. And unfortunately, being totally realistic, that's probably not going to happen. But if you're expecting that or hoping for that, that can lead to frustration. And I know that some investors give up far too early when they actually could have been a success if they just hung in a little bit longer and been a bit more persistent.
Sorry, Peter.
I don't know if you ever heard that.
Sorry, can I just stop you right there because I think we've got a really bad line again. If all the attendees are okay to hold for just literally 10 seconds, I'm going to see if I can sort out this connection. Right, bear with me. Right. Sorry, I'm just dialing into Peter again, just because I think we've got a really bad connection this evening, and we did have a few IT issues.
Hello?
Peter, have we got you back online?
Yeah, just grab the phone, Arsh.
Fantastic. Okay, so I do apologise for the tech issues, but it's way beyond our control this evening. I don't know why the webinar company seems to want to. They don't want you to speak, Peter.
Right. Well, we will battle through anyway.
Now, just by if you can still hear Peter, can you just let me know with a clear yes or no in the answer box, please?
Yeah, can you hear me? I'm here.
I'm hoping that this will be a far better connection. Perfect. Okay, everyone's saying yes. Everyone's saying yes, and I'm hoping that this is a lot better because I'm hoping that this is going to be a far more stable connection. So Peter, we were at the point where were we talking about how do we buy and finance our property, or how do we find the right property?
Where we're talking about what do we want from property.
Right. Okay. So off you go.
Right. How much did you miss, Arsh? Do you want me to start the whole thing again?
No, let's not start again. Let's talk. I think from people asking is what's the right? How do they figure out what the right strategy is to get what they want?
Right. Well, that's what I'm going to be covering sort of step by step through this presentation anyway.
Okay.
So it will all become clear as we go through. But just as a very quick summary of that very first part, which I was talking about, we really need to know what we're trying to achieve from property. And a problem which I come across quite often with investors is they're not really sure what they want to achieve, Arsh, which might sound a bit odd. It's all a bit vague. They just know that they want to achieve something from property like income or wealth or whatever it happens to be. So the starting point is the investor needs to know exactly what they're trying to achieve and why, and then try and express that as very clear, focused, written goals, preferably with financial targets attached, so that we know exactly what we're trying to achieve. Then we need to set a realistic time frame to actually achieve those goals. And unfortunately, many investors who I meet, they want to achieve far too much too quickly. They want to produce their income from tomorrow, and that's just not going to happen. Have you heard that expression, Arsh, that you can probably achieve less in a year than you hope to, but more in 5 years than you can imagine?
Yes, indeed, I have.
Well, I think that really, really sort of sums up property, because I think it's very easy to sort of get all very despondent, thinking, well, I haven't really achieved very much in the first year. But if you give yourself a long enough time period, then I know that anybody pretty much can be a success in this. I mean, for example, and I'm only using 5 years as an example. Our listeners may want to use a different time frame altogether. But say we were working to a 5-year plan. Well, even if we only bought one property in our first year, we could then maybe buy 2 in our second year, and maybe 2 or 3 in our third year, and maybe 4 or 5 in our fourth year. And obviously with the market recovering and with the income coming in from that, it could be that in the 5th year we could buy 8, 9, 10, 11, or even more properties. And so the effects can actually grow very significantly over time like that, which is why if we have a realistic time frame, we're not going to become frustrated and overwhelmed and give up too soon. I mean, it's probably quite hard for people to imagine this when they walk out of the estate agents that very first morning and they've got in their hand maybe a whole bundle of details of properties which they know aren't really very suitable. But actually, if they just do 1 or 2 deals in their first year over a 5-year time frame, then they could certainly end up with a very significant portfolio indeed. So, moving on to the next point, what's the right strategy to get what you want? Well, once we know what we want, it's obviously much easier to come up with a strategy that actually fits with what we're trying to achieve, if that makes sense.
Of course, yeah.
And if you think about it, I don't know what you think about this, Arsh, but in my opinion, and this is only my opinion, I think there's only 3 basic strategies in property. And they are buy and hold for income, buy and hold for equity, and buy and sell for cash. And I'd argue that all other strategies, or what we call strategies, are actually sub-strategies of these, or even just techniques. But I'm not going to get into semantics and argue the point tonight. Basically, we can buy a property for income, we can buy it for equity and capital growth, or we can buy it to sell. And those are the 3 main things that we can do in property. So when we know what we're trying to achieve, then obviously we can tailor our strategy to achieve that. Now, I know that this probably sounds very, very simple, and some of our listeners tonight might be thinking, well, this is very simple. But I make no apologies for that, because I think simple is good. And I think one of the reasons why some investors get a little bit sort of bogged down is because they become sidetracked by trying to do everything sort of in a more difficult way, which isn't necessary.
Can I just butt in there, Peter? I can relate to that, because when you're a landlord of my size, when you've got 500 tenants, I sometimes think, well, maybe I should do this, maybe I should do that, and really, property is such a simple and safe investment, but yet investors like myself, we make it more difficult than it needs to be. Would you agree?
Yeah, definitely. Definitely. One of the reasons why I find investors who've been trying to get into property for quite some time, but they've never done anything, is because they're completely overwhelmed by the choices. Choice of property, choice of strategy, choice of technique. There's just so many ways of doing it. So I'm absolutely convinced that particularly when you get started, just keep it simple and go for the simple way of doing it. Once you've actually mastered the simple way, then you can add in the fancy techniques and strategies and do things differently. But tonight I'm talking simple, and as I say, I make no apologies for that.
Okay.
So once we know what we're trying to achieve, then we know which of those basic strategies are going to fit with what we're trying to achieve. So, again, it sounds obvious, but if we want income, then most likely the strategy we're going to use is to buy and hold some properties for income. And that's going to mean looking for properties which we can buy cheap enough so that we can have a low enough mortgage so that our monthly outgoings are low enough to give us cash flow. On the other hand, if our goal is to produce equity or wealth, and by equity, what I mean there is the difference between the value of the property and any mortgage we hold on it. So that's basically our chunk of wealth that's in the property. But if our goal is to produce equity, I mean, for example, somebody might want to buy some properties to supplement their pension in 15, 20, 25 years, then that will require buying properties where there's also going to be a genuine expectation of significant price rises. And we may be able to find those by using the stats. We know, you don't have to be a genius at the moment to see that London and the South East are sort of booming at the moment, and the prices are rising very rapidly. But in a more general sense, it might mean looking for properties in a regeneration area, or an area marked for new infrastructure, or a suburb that's gentrifying. But if you're going for equity, one thing I would say, Arsh, is don't forget the investment fundamentals. Don't get so caught up in looking for the capital growth that you actually forget to buy a property where the rent is going to be sufficient to cover all your costs. We don't want to buy properties that are going to be sucking money out of our pocket.
Well, I can, if I can just butt in there, and just to give you a clear example, where I'm based in Wolverhampton, I very much doubt that we could buy for capital growth, purely because property prices aren't rising as much as, let's just say, London, which is a complete animal in itself. But then saying that, I can definitely buy for cash flow, because property prices are a lot cheaper, which means that my mortgages are a lot cheaper, which means that as I rent properties out, I can generate a lot more cash flow. So my strategy would be cash flow, but then depending on where you are across the country, if you're in London, I can imagine your strategy being capital growth. But obviously you're going to end up paying a lot more for the property, with a view of it within even a year or so, it being worth a lot more than what you paid for it.
But in the meantime, you've got to be able to service it. You've got to be able to make sure that you can pay the mortgage on that property.
Of course.
And what I find, Ash, is, and again, I'm not wanting to sound critical, I'm just trying to sort of help people with this, but I come across investors who buy in an area like your area, where there's not much prospect of capital growth, and then they're disappointed they don't get the capital growth. But on the other hand, I find investors who are trying to find properties in London, but they just can't afford the monthly payments. So it's a real balancing act, and this is why it's absolutely essential that you're clear on what your strategy and what your goals are, so that you don't get sidetracked by that sort of thing.
Okay.
But of course, rising prices is only one way of obtaining equity. I'm sure that many listeners will have heard about buying below market value, which of course is a way of building equity in on day one. And of course we can target properties where we can add value, which would usually mean, but not always, where we can repair, renovate, modernise and improve, and where we can undertake works to the property which actually add more than the cost of the works themselves. And we're going to be talking a bit more about that later in this presentation, Arsh.
Okay.
And then, of course, we can think about how we actually structure our deal, whether we go on an interest-only mortgage or a capital repayment mortgage. And the received wisdom in the investment world largely suggests that most investors go for interest-only mortgages. But there's some, and I know that you're one of them, who swear by capital repayment. And I guess we could probably have sort of quite an interesting discussion at some time about that, because I know that you have sort of quite strong views as to why you go for capital repayment. But again, it all comes down to strategy and what you're trying to achieve. If you're after cash flow, then naturally you'd probably be steering towards interest only. If you're going for paying down the equity to increase the equity, then obviously the capital repayment loan is the way to go. But it's about being clear, Arsh. That's what I think. It's about being clear about what you're actually trying to do and achieve.
Okay. I completely appreciate that. A couple of people are just asking a few questions. Some people really want to know about how they can reach financial freedom. They really want to start looking at some of the meaty stuff about how they can actually start to finance their properties, how they can buy properties and actually cash out and make so that in essence they've got no money left into the property. Is that something that you're going to cover today, Peter?
Yeah, I am. Yeah, well, that's coming up in a few minutes.
Perfect.
Right. But just before we move on from strategy, Arsh, I think it's also worth bearing in mind, particularly if anybody's listening who's just about to start out or who has just started out, to think about their exit before they go any further. I know it might sound a bit premature to start thinking about exit strategies before you've even started, but now is the time to actually structure your property business to correspond with what it is you're trying to achieve. It's that whole thing about starting with the end in mind, because it's going to be very hard once you've actually got yourself up and running and you've bought a few properties and, you know, perhaps been investing for a few years. If you then decide actually the exit strategy you were heading for isn't the right one and you need to restructure everything, I mean, it may or may not be possible. And chances are, if you've got to get lawyers involved, it's going to be expensive anyway. So it's much better to think about that before one starts.
Okay.
Also, there are a number of strategies available to an investor. So I've never been one for saying you should only ever use one strategy at a time. Even if your strategy or your goal is, say, to have income, I still think that there's good reasons to perhaps, you know, buy a few properties for equity along the way, or particularly if an investor needs cash. As I say, a lot of investors are a little bit unrealistic about when they're going to receive their income from. They want it too soon. But there's no reason why they shouldn't do some trading, some buying and selling alongside, and bring some lumps of cash into their property business or into their bank account if that's what they need.
Can I just elaborate on that, please, Peter? Okay, so Peter's made a very valid point. That let's just imagine that you've got £25,000 that you want to put into property. Now, £25,000 really won't get you very far. It will probably allow you to purchase one property. And let's just work on the basis, and I'm using all the assumptions that it's somewhere close to me. So let's just work on the assumption that if you do it on a standard buy-to-let and you rent it out to a professional family, you'll probably get about £500 a month, which is about £6,000 a year. After you've taken out all your costs and all your maintenance, plus any void periods, you know, you're probably left all in all with the best part of £1,000 to £2,000. Now, if you were reliant on that £1,000 to £2,000 to build another deposit for another property, you could be there quite a while. And so it may be something, that you're It will take you a long time to go. So maybe you may start to think about how you can leverage your cash so that you could do a few deals before you go off to buy your first property. And let's just say that you buy a property that you're going to potentially do a light refurbishment on, where you buy it potentially with a mortgage, or you could potentially buy it if you've got the cash to buy it. And let's just say that you buy it for £100,000, but you manage to uplift the value to 125. Now, if you bought it with a mortgage, potentially you've now turned your £25,000 cash into £50,000 cash, which then allows you to possibly look at two properties as opposed to one. So there's lots of things that you need to consider, and I would certainly agree. There's lots of other strategies that you can look at without complicating it. Stuff such as rent to rent. I'm a big advocate for rent to rent now. One of my rent to rent companies generates just over 10 grand a month in rental income, but yet it hasn't cost me anything to acquire those properties. So that's £10,000 or £100,000 a year that I'm generating of properties that I don't own, but yet I still have control of. So I don't know if I've complicated it far too much there, Peter, but hopefully I've kept the fundamentals the same.
Yeah, no, I agree. And in fact, there's another trainer who teaches the 3-2-1 rule, where he suggests that of every sort of 3 properties that you buy, you maybe hold 2 and sell 1, so that you're building your portfolio and you're bringing cash in as well. Well, I mean, I don't think we need to be prescriptive about it. It's up to each individual investor to decide which numbers are right for them. So it may be 3-2-1, buy 3, buy 3, keep 2, sell 1. Or you may want to buy 3, keep 1 and sell 2. Or it may be a 5-4-3 that works best for you. But the point is that by looking at what you're trying to achieve and looking at the mix of strategies, you can sort of mix and match. So you can be building income and building a bit of equity and buying and selling and bringing some cash in at the same time.
Okay, have you got time for a question here, Peter?
Yeah.
Right, first of all, I'm going to answer Annette's question, which is directed at me. She goes, Arsh, those rent-to-rent properties must cost you something, fees, refurb, etc. Believe it or not, Annette, I'm one of the rare breeds that will not spend a penny other than maintenance on someone else's property. My philosophy is, if I don't own it, I'm not spending money on it. So I don't spend any fees on refurbs. I don't spend any fees on deposits. The fact is that I find landlords who want to give me the property and they want me to look after it for 5 years. I don't pay anything up front for them. I know a lot of people that will talk about rent-to-rent strategies and say that you have to pay deposits, etc. But I don't believe in that. I believe that it is very straightforward, no money in strategy, providing that you structure it correctly. And then another person, James, who's on the line, has asked, as a new investor, what is the cheapest hands-free portfolio I can get into with £30,000? The cheapest I found was 11,000 to get 5 houses sourced for me at 25% below market value. If I'm honest, I don't really understand the question. Anything that you can do?
Well, I think the principle is that if you're talking about buying through a packager or a sourcer, they'll be using pretty much the principles that we're going to be going through in this presentation anyway. So I've got nothing against packagers and sourcers as long as they do a good job. Many of them do. Some of them do a terrible job, and you need to be very, very clear on who you're dealing with. You also need to be very, very clear what it is they're trying to sell you, because at the end of the day, they're just trying to make a profit, as we all are. But I would always suggest that before an investor goes down the route of using a sourcer or a packager like that they sort of look at the principles which we're going to talk about tonight and which we're going through, because they could probably source the properties themselves. If it's a question that they genuinely don't have time, then that's another argument. But if you can source your own property, then you will benefit from the profit which the deal packager or sourcer will obviously take off you if they source the property for you. So the more of that profit you can keep, then the bigger the portfolio you can go on to accumulate anyway. But as a general statement, and obviously I'm not an IFA or a financial advisor, and I can't give advice on investments, especially with the new regulations that have come in, but I would have thought that £30,000 is a very handy amount of money. And I would think that if the listener bought right place, they'd be able to put together quite a sizable portfolio with that.
I completely agree.
I mean, using the principles which we're going to go on to later, of being able to take their money back out and go again, then it almost becomes a point of how many do they want to buy?
So
the only thing you've got to think about is the banks. But, there's so many buy-to-let lenders out there, and most buy-to-let lenders are quite happy for you to buy as many properties as you want, as long as you don't borrow all the money off them. So you might have to go to half a dozen different lenders, but you can accumulate quite a large portfolio.
Okay, well, I'm just looking at some of the questions that are coming in. A lot of them are really interested in the finance aspect of how they can acquire properties, what they have to do in order to be able to recycle their cash so that they can go out and buy more properties. So is that something that we can start talking about now, Peter? Because I am very conscious of time as well.
Yeah, absolutely. Okay. Right. The key thing, if we're going to recycle our cash, is that we need to be buying a property either cheap enough, where we're going to have substantial equity in the property, or where there's enough works to do in the property where we can significantly increase its value, or even better is to buy a property which needs work doing to it, which we can buy cheaply anyway. So this is quite difficult to explain, but I'll give it a go, Ash.
Sorry, Peter, just because I'm controlling your slides, just for the listeners. What slide are we on?
Well, if we're jumping ahead, I'm not quite sure, Ash, because
Okay.
I was a bit further down the line, but we're jumping quite a long way ahead now.
No problem. We're all about improvisation here.
Yeah, absolutely. If I was you, the one which has got like the 6 bullet points on, 7 bullet points.
Yeah.
Just stick that one up.
Okay,
and that'll cover everything.
Okay, perfect. So what can we do with our money to help make real money and how to refinance our properties? So let's start talking about the meat of how they can use their cash and leverage that cash.
Yeah. Well, as I say, the key thing is we're going to go out and we're going to look for a property. We're going to give ourselves a realistic time frame, so we're not running around like headless chickens and panicking. Because what we're going to do is we're going to find, going back to the very beginning of this presentation, we're going to find the right properties. So we're not going to panic if it takes us 2 or 3 months to find our first deal. We're going to find the right properties to make this work. And in that context, the right property is going to be one where we can buy cheap enough that there's significant equity in the property, or where the property needs some work doing to it, and there's enough work whereby we can increase the value by more than the cost of the works. But the best option of all is to buy a property which needs some works and which we can actually buy cheaper than the price that reflects those works, if that makes sense.
Can you break that down into simpler terms?
Yes. Well, let's say, for example, that a property in good condition is worth £100,000. Okay?
Yeah.
It's in good condition, it's worth £100,000. Now let's assume it needs some cosmetic works doing to it, like a new kitchen and a new bathroom and maybe redecorating. And maybe the estate agent has priced that at £80,000. So it would be worth £100,000 in good nick, but it's maybe priced at £80,000 because it needs some works doing to it.
Okay.
Now, what we want to do is obviously buy that same property, but maybe buy it for 70 or 65 or even 60. So we're basically buying it with a double discount. We've got the discount for the works, but we've got the discount because we're just buying it cheap anyway. And then that gives us plenty of margin. Now, as I say, that is the ideal, and it may be that we can't always achieve that. So the next best option is to buy the property either with perhaps 20-25% discount because we're just buying it cheap, or alternatively, to get it with a 20-25% discount because it needs a load of work doing to it. But once we can get a property with some margin like that, then we're ready to roll, and it's looking good. So that's the ideal sort of property that we're looking for. And I always say this is like panning for gold, because there's not many out there, and there's quite a few people looking for them. But we only need to get one at a time. And I know that a lot of investors get very, very frustrated. But just remember, you only need to do one deal at a time to move forward. And we're just concentrating on that one nugget. Now, once we've got that property, like I say, we're ready to go then, because then we can start doing the bits and pieces to start enhancing the value. Now, just going off at a slight tangent, I've just said that the best way, the simplest way, and I was trying to keep it simple tonight, but the simplest way, which most people will understand, is doing a property up and adding value. I mean, we all watch Homes Under the Hammer, for example, and we all see people doing it on telly week after week. So I think we all understand the concept of that. But that's only one way of getting the property cheap. As I said just a minute ago, it may be that we can buy below market value because of usually that's because of the situation of the seller. I mean, I'm sure that we're all very familiar with that. You know, where somebody's in financial difficulties or where there's a divorce or whatever, people might not really care what they get for the property. They just want to get out. And so there's an opportunity to help them to sell the property quickly, for which they'll take a lower price. But other investors maybe do something a little bit more sophisticated, like title splitting. And I came across one just a couple of weeks ago, Arsh, which I put an offer in on, and I'm still waiting to hear whether the offer's been accepted. But I found a pair of flats which have never been occupied by an owner-occupier. They've only ever been owned by an investor. And so I can buy the freehold of this pair of flats, but you know how usually if there was an owner-occupier, each flat would be sold on separately, and they'd both be on a long lease.
Yeah.
Well, the long lease has never been granted because the freeholder was the investor, and the investors just let them out. That hasn't ever been done. So I've offered 70, which is very close to the asking price, because I know that if I can buy those properties, I can then get a solicitor to draw up a long lease for each of the individual flats, and then I can sell them on separately to owner-occupiers. And
how much would each one be worth?
Well, I reckon there's about 50,000 profit in there if I was able to do that.
So just so that people can understand, so there's a property that's been converted into 2 flats. I'm assuming ground floor and first floor.
Yes.
Okay, so you're going to be buying the whole building for £70,000.
Yes.
Then what you're going to be doing, you're going to be splitting the building on land registry. So it's got 2 separate titles. So you'll still be the freeholder.
Yeah.
And you'll be selling off the leasehold. I'm assuming either 125 years or 999-year leases for the ground floor and the first floor. And if you work on the basis that you're going to be selling each flat for around £60,000, is that correct?
Yeah, or more. Yeah, 65-ish probably.
So, for argument's sake,
but to get the solicitor to draw up the leases isn't going to cost very much, and I'm probably going to have to get somebody to draw a lease plan for each property. But we're talking about a very small amount of work in order to release quite a large amount of value.
So it's very straightforward to do. So you've bought it for 70. Hopefully, if you carve them up correctly, the whole building should be worth around 120. But you're going to split it into 2 flats, which means that each flat will be worth £60,000.
Yeah, give or take. Yeah.
Okay, yeah. Fantastic.
So I mean, that's quite a simple example.
No, Peter, I'm just going to stop you right there because someone's asked, and Adam's asked a very straightforward question here. That's very smart, but but in that scenario, would you have to be a cash buyer?
It would probably help, in all honesty, yes.
Do you mind if I butt in here, Peter? Okay, Adam, I'm going to answer your question very directly because I believe that if you don't have the cash to buy the property, that is not your be-all and end-all. The reason why is that there are so many different options out there for you, but I still believe that property investors don't take them or don't take advantage of them. And I'm going to throw in 2 words, bridging finance. Now, Peter's probably just thought, well, what the bloody hell is Arsh talking about?
Or I'm trying to keep it simple tonight. But
yeah, we are. But for this example, let's just say that Adam wanted to purchase this property, but he didn't have £70,000 cash. What I would do is I would approach. Well, you've got 2 options. Your first option is that saying, okay, admit defeat. I haven't got £70,000, so I will not buy that property. And you will let another property investor step in your shoes, and they will profit from it. Now, second option, which I would do, is if I didn't have £70,000, I would go to a bridging company, providing that I'm confident with the fact that I can buy the property for £70,000. They will lend me approximately 70 to 75% loan to value, which means that in this scenario, I would probably have to put in the best part at £75,000, 75% loan to value on a £70,000 purchase would mean that I would probably have to put in the best part of, let's say, £17,000 plus legal fees. You'd need about £20,000. If you haven't got £20,000, unfortunately, you're at a no starter. Now,
well, not unless you go and borrow it from somebody.
Yeah, you can borrow it from friends and family. So, so you've got your bridging finance, and now bridging finance normally gives you either a 6 or 12 month temporary bridge, and it's called a bridge because it gives you a timescale for you to go in, do any works, create the uplift in value, and then you can refinance the property yourself with a high street lender or sell the properties on. As long as you're confident that you can repay the bridging company within 6 or 12 months. It can be expensive because bridging companies can charge anything between 1 to 1.5%.
But the thing is, though, Arsh, in that example, even if you're calculating the expenses, and I'm doing this off the top of my head now, so I'm not giving precise figures, but even if you only make 35,000 on your 75,000 initial investment,
exactly,
you're only putting 20,000 in. You're making more than 100% on your own money.
And this is my point, Peter.
After paying the bridger.
This is my point. I see so many investors who'll say, "Well, sorry, I think I'm going to have to let that deal go to someone else." And this is where I step in. I bought 2 5-bed mid-terrace properties, and they were owned by a monastery, which means that it was occupied by nuns. I watched them on the market for 2 years. They were originally offering £400,000 each, meant that they wanted £800,000 for the pair. I watched them, and I watched the price come down. I watched investors go in. They had the vision, but they didn't have the cash. And I bought both of them for £230,000 for the pair. And at the time, I'd bought other investments, so I didn't have £230 liquid cash. So I used a bridging company. At the time, the properties had a wall which had knocked through to create one big property. So whilst I use a bridge to purchase the property, I used my cash to do the refurb on the inside of the property. And then within 6 months, I had that refinanced. I had it revalued. Each property got valued at £200,000 each. And now I've got 2 5-bedroom properties that I own. So don't discount just because you haven't got you haven't got all the cash to purchase the property outright. There's so many options out there for you.
Absolutely. And as I say, we're trying to keep it simple tonight, but you just never know what you're going to stumble across. And although I'm trying to sort of keep it simple by talking about renovating and improving and modernising and doing the usual thing, the homes under the hammer route, but you just never know what you're going to come across. And there's always an argument for being opportunistic and jumping in on something like that. And it could be that one deal could change your whole life.
And just where we are at this point, Peter, I'm just going to use your example. Let's just say that now Peter has got this property that he's bought for £70,000. Now he's got the bridge for £70,000. Now after he's done the work, and each property is now valued at £60,000 each, providing that you've got a lease that you can show the mortgage company, you could potentially lend 70% of the £60,000. So my maths off the top of my head here, 70% of £60,000 is around £42,000. 4, 6, 12, 18. Yeah, £42,000. Times that by the 2 flats, you can potentially get mortgage of £42,000 each flat, which is £84,000. Remember, you only paid £70,000 for that property, which means that you can pull out £14,000 out of that property for you to use as your next deposit on your next property.
For each flat?
Exactly.
So it's
it's £14,000 for the pair.
Oh, is it right? But to be honest with you, Arsh, what I would do in that situation, here we are making this up on the hoof as we go, but my intention with that would just be to sell it on. I've already spoken to the local estate agents, and the local estate agents have said they're perfect for first-time buyers. They're just within their price range. They're in an area where a first-time buyer would be very happy. and I'd just flip them on. I'd pocket that money, and then I'd go on and use that money to then start building my portfolio or add into my portfolio and keep it really, really simple.
I completely agree. So moving forward.
Yeah. So, I mean, carrying on with where we were going, because that's sort of a bit of a tangent, really, but I just wanted to sort of show everybody that there are opportunities out there, because I wasn't expecting to come across that, and I wasn't specifically looking for that type of property, but it just happened to come my way. And I thought, well, I'm just going to have a go at this, because, as I say, I've put the offer in, I'm waiting to see if it happens. If it does, that's great. If it doesn't, well, there's plenty of others out there which we're going to come across anyway. But what I'm primarily looking for is properties where I can do those works to add the value. And what we're really talking about is cosmetics. And I know that that's probably very obvious, but as I said at the beginning, keep this simple because simple is good. So we don't want to find a property which needs a lot of work doing to it, as in structural work. We certainly don't want anything where we might have to apply for building regulations and get a building control officer involved. What we're looking for is something nice and simple, like putting in a new kitchen, a new bathroom. It may be putting in central heating, and as I always say, that might sound like a big job, but it's not actually a big job for you. It's the plumber's problem, and they know how to do it. So I would include central heating as not being a terribly big job. I'd call that cosmetic for the purposes of this definition. And it could be something like new windows. You'd be amazed what difference putting new windows can make to a property, how that can really freshen a property up. So that's the kind of project that we're looking for. And in fact, I've actually just got one which I'm exchanging on hopefully next week, Arsh, which I was going to tell you all about.
Okay, yeah, let's talk about it.
Right, well, just sort of going back a couple of steps, people quite often ask me, well, how do you find projects like that? It must be really difficult. Well, it's not really. And keeping this simple, which is the theme of tonight, I'm always surprised at how many investors turn their noses up about the idea of finding properties at estate agents. Now, I don't know why that is, to be honest, because if you think about it, if somebody's going to sell their house, 90 or 95% of the time, the first thing they're going to do is ring up the local estate agent and probably put it in the hands of an estate agent. Now, I know that the main objection is that all the best deals get hidden in the bottom drawer, and the estate agent only offers those to their preferred clients. And that is true. We know that happens. And it can take time to nurture a relationship with an estate agent so that you get those deals. But the truth is that there's plenty of other deals which may not be the very best deals, but they're still plenty good enough. The difficulty is, though, that when you look at the details in the window on the Saturday morning when you go to see the estate agent, those deals aren't marked, are they? They're not marked as, this is a fantastic deal, buy it below market value, make us a stupid offer. And so it's our job as property investors to actually dig around a bit and to unearth those deals. And the only way we're really going to be able to do that properly is once we know our patch inside out. Once we know our patch inside out, when properties come onto the market, we get a better idea. We'll know from looking at the price whether it's a good price, whether it's expensive, whether it's cheap. And if it looks cheap, that could be very interesting, and we should be then straight round there looking at that property and maybe even making an offer with the way the market is at the moment. But those deals are certainly out there. And just to prove the point, I've done most of my investing up in the northeast of England, Arsh. But the silly thing is, I actually live in the Midlands. And I'm getting I'm quite a bit older now than when I first started. And the journey backwards and forwards on the A1 is beginning to tell. I've done it too many times. And so last year, I decided that I was going to change my patch and I was going to start looking for properties nearer home. So a couple of months ago, I decided that I was going to start from scratch in a completely new area. And so I did basically what a lot of the listeners might be thinking of doing. I was pretty much starting all over. I'm starting again, almost as if I was a novice investor, because I don't know the area around me, ironically, as well as I know the northeast. Because I invest up there, I know the northeast really, really well. But the nearest town to me is just the nearest town to me, where I used to go with my wife to Starbucks on a Saturday afternoon, and I never really thought about it in investment terms. So it was a really interesting exercise for me to actually go and start again from scratch. So, a couple of months ago, I put a line in the diary and I set aside one Monday to go into town and to go and register with all the estate agents and to see if I could find a deal. Now, anybody who knows anything about investing will say that Monday is probably one of the worst days you can choose to go and see estate agents. There's far better days in the week to actually go and see them, which I'm not going to go into now, but it certainly isn't a Monday. And so there I was on the doorstep, 9 o'clock Monday morning, looking through the window, and you know how it is, they've usually got a couple of desks near the front and a couple of people sitting in those desks. Well, they could see me looking through the window, and they were looking down at their pads of paper or at their computers, whatever they're doing, pretending to be busy. So I had to kind of steel myself because, believe it or not, I'm quite a shy person, really. And I forced myself through the front door of that first estate agent's office, and everybody ignored me. And I stood there for what seemed like ages. It was probably only about 30 seconds, but I just stood there sort of hopping from foot to foot, thinking, what do I do now? But eventually one of them kind of said, yeah, can I help? And that was the start of my day. And it wasn't easy. I'm not saying it's easy, but it just had to be done. And the reason I should say why I did it on a Monday was because I was busy all the rest of that week, and I knew that if I didn't start then time was just going to slip by and I'd procrastinate and I just wouldn't get on with it. So I thought, I'm going to take action. Well, that day, that Monday, I went round probably about a dozen agents, and in that time, I found a deal. Now, it didn't become a deal immediately, and as I said, I'm hoping to exchange on it next week. So it's been the system. But it just shows that if you go and look, you can find those deals. Now, a useful tip here, the reason why I got that deal, and interestingly, why I got the last deal I did before that, was because I was able to say that I was a cash buyer. Now, I know there may be some listeners who aren't cash buyers, and we'll talk about that in a minute. But the reason why I was able to get that deal is because this property had actually been under offer to an owner-occupier who was buying with a mortgage. But it had been turned down on the valuation. And the reason why it had been turned down on the valuation was because the valuer had said that there was some movement to the rear elevation, which he wasn't very happy about. So the estate agent rang me up and basically said, at the point where they introduced me to the property, they said, well, there's a valuation going on the property. We're not sure how the valuation is going to work out. We think it's going to get turned down. Come and have a look at the property. If it gets turned down, you can have it. And I said, well, what if it doesn't get turned down? And they said, well, if it doesn't get turned down, the other people will buy it. So I felt a little bit miffed about that. But, it was worth actually sort of being a little bit humble, because in the end, the property was turned down on the valuation. And the agent came back to me, having already primed their client, saying, this is only going to go to a cash buyer now, so you're going to have to accept a cash buyer's price. So I didn't have to do very much negotiating at all. I considered a cash buyer's price. But the interesting thing is this. When I looked at the property, I could not see the movement to the back elevation that the valuer was so worried about. I think there's been a little bit of movement where a window's been changed, and perhaps it needs a lintel. But if you think about it, a lintel's probably about 50 quid, and it'll probably cost about, maybe 150 quid to get a jobbing builder in to put a lintel in, so it's not a big deal. But this property was turned down because I think the valuer has been a bit over the top, but that's unfortunately how valuers are at the moment. They're very twitchy. But the point was, I was able to buy this property at a cash price. Now, if you haven't got the cash, then obviously that sort of opportunity may not fall into your lap. So going back to what Arsh was saying, we're not keeping it quite as simple as I thought we were going to, Arsh, but there's ways and means of actually getting the cash together, aren't there?
There is, definitely. 100%.
I mean, the first thing I would do is actually just ask around and see if there's anybody who wants to come in and buy the property with me, which is very obvious, but very few investors like to do that. I know that we're all a bit British and we don't like talking about money, but I'm sure there's plenty of people out there with money who'd love to make a bit of money on their money at the moment. And so the idea of doing a property deal, I'm sure, would excite a lot of people. A lot of people are watching homes under a hammer like we are and thinking that they could be wishing that they could be a part of that.
Okay, Peter, in one of your in your strategy or your step-by-step process, do you talk about how you speak to estate agents, or what you should be talking to an estate agent about, how you build that rapport?
Yeah, definitely. I'm not going to cover that tonight because I haven't really got time, Arsh.
I completely agree.
But it's certainly something we can look at. I mean, just to give you a tip on that, I was talking to one of my friendly estate agents the other day who was telling me how the estate agents in her office had actually scratched an investor off their list and they'll never receive any details again. And what had happened was that they had a property on the market which under normal circumstances would have been the £100,000 property. But because it needed some bits and pieces doing to it, the agents had put it on at a price of 80. But an investor had gone around and looked at it and then offered 50, which was, the agents already felt they'd discounted it quite significantly anyway, down to the 80. So when the investor offered 50, they just thought he was taking the mickey. And apparently he's never going to receive any more details from them. So you do need to be careful about how you deal with agents and how you nurture your relationship with them. But yes, that's certainly something we look at.
Okay, so moving forward then, Peter, I'm sorry, I think I skipped ahead because I think we're slightly running out of time. We're just past the hour mark.
Oh, okay. Are we already?
We are indeed. Time flies when you're having fun, my friend.
It does indeed.
So
let me talk about financing these deals then, Arsh, very, very quickly. Can I have 5 minutes just to quickly talk about finance?
You can.
Okay, well, I mean, there's two ways really of financing these deals. The first is cash. And if you can buy a property, buy it for cash, do it up, and then after 6 months, then you can finance it. Obviously, we've got the 6-month rule to be aware of nowadays. I'm not going to go into all that because I'm sure most people are familiar with it. But the advantage of financing like that is, depending upon which lender you go to, you might be able to get a good loan-to-value ratio. I mean, for example, the Mortgage Works will give an 80% buy-to-let mortgage to an experienced landlord. So it's possible that by doing it by cash and then financing, you can get a decent amount of money back out. If you haven't got the cash, then I'd certainly think about bringing in a partner to fund it for you, or maybe a number of partners. It may be not just one person, but maybe if you sort of split it as a consortium, maybe 3 or 4 people, maybe a few relatives rather than just going to one. Because I'm sure that most people have got a bit of money which they could contribute. So that could be a way forward. The other way to finance it, though, is by using the light refurbishment loan, which is what you were talking about earlier. And they all but disappeared when the credit crunch happened, but I've noticed they've started coming back now. The Mortgage Works do a 70% light refurbishment loan, and Paragon, who are a big buy-to-let lender, they've got a 75% light refurbishment loan. And then there's other smaller building societies. I think Saffron Building Society do a light refurbishment loan. So they're certainly coming back. And I suspect that over the next few months, as the market continues to improve, then the loan-to-value ratios will increase as well, which will make our job that much easier. But the basic principle behind a light refurbishment loan is that, strictly speaking, a buy-to-let lender doesn't like to lend on a property that isn't habitable from day one. Obviously, they're relying upon you renting the property out immediately to be able to service the loan interest. So if you can't rent it out, that puts the bank at risk. Now, some investors wanted to be able to take properties on that needed works doing to them for the reasons that we're talking about, so that they could add value. And so eventually, some of the more astute lenders developed what we now know as light refurbishment loans. And just taking, say, the Paragon one as an example, because they give a 75% loan to value, what would happen is that you would buy the property, you'd make your offer on the property, you'd apply for the buy-to-let loan, the light refurbishment loan, and the lender, in this instance Paragon, for example, would send their valuer around who would value the property. Paragon would then lend you 75% of the value or the purchase price, whichever is lower, although in most instances they're usually the same, aren't they? Because the valuer usually values it at what you're paying for it, hopefully. But they'll lend you 75%, but they might deduct the cost of the works, what they call the retention, which they'll then hold back. But at the point when the valuer is going around to value it to buy now, they'll also do a valuation assuming the property's actually been done up. So they'll report 2 values. You will then draw down the first loan and buy the property. You'll do the works, and then when you finish the works, you'll notify the lender. The lender will send the valuer back out. They'll then make sure that the works have been done to the right standard. They'll then confirm that their original estimate of the future value, as it were, is correct. And assuming it is, you can then draw down the balance of the loan. So it saves having to go through all the hassle of financing and refinancing and more legal fees and more valuations. It's a nice, quick, simple way of being able to buy a property that needs works and know that you're going to get finance with it. And of course, the beauty of it is that it's kind of like a fail-safe system, because the valuer will go out and do the valuations. He'll do the future valuation. So you'll know exactly whether your project is going to stack up or not. Obviously, if you're going to buy for cash and then finance, unless you get a valuer to come around and pay a valuer anyway, before you even thought about which bank you go to, then you're not going to be absolutely sure whether the property is going to value properly when you've done the works. But with a buy-to-let like refurbishment loan, the valuer is actually going to give you the figures on day one, which means you can go ahead with a lot more confidence possibly than if you sort of cash bought it and then refinanced. Does that make sense, Arsh?
It does indeed, yeah. It does. It makes perfect sense.
I think that's a brilliant product. When people say, well, how can I build my portfolio? It's as simple as that. Buy a property where you can add enough value, where preferably get a light refurbishment loan, do the works, and then draw the money back out. The key thing, of course, is to make sure that the end value of the property is high enough to be able to refinance to get all of your money back out. And the basic formula is that 75% of the end value of the property must equal or exceed the cost of purchase, the cost of works, the cost of the legals, and the cost of applying for the mortgage. Does that make sense? Shall I just repeat that?
Yes, please, if you could.
The 75% of the end value of the property must equal or exceed the total cost of the purchase price of the property, plus the cost of the works to do the property up, plus your legal costs, plus the cost of applying for your mortgage. Okay. Because if the value is high enough, you can then pull all of your money back out, and then you're off again.
Okay. Annette, who's listening, has asked, where could she find out more information on the light refurb loan?
Very easy. Google. Just Google light refurbishment. It'll probably, if it doesn't, but it should, it'll probably direct you to the Mortgage Works.
Is that with TMW, the Mortgage Works?
The Mortgage Works, TMW.
Yeah.
Yeah. And Paragon. If you go onto the Paragon website, which is paragon-mortgages.co.uk. Paragon-mortgages.co.uk. And look at their website. There's bits and pieces there about light refurbishment.
Okay, so moving forward then, Peter, are you going to be explaining any more? Have you got anything happening over the next couple of weeks?
Well, we knew we were going to have to go through this at quite a quick speed, didn't we, Arsh? Yeah. And so I have put together a weekend workshop where I can go into this in a lot more detail than we've been able to go into it tonight. And you very kindly agreed to host it, which is wonderful, down in Wolverhampton.
And so that's happening on the 22nd of March?
It's the 22nd of March, a one-day workshop. We'll be starting around about sort of 9:30 registration for a 10 o'clock start and going on till about 5:30. Yeah. And it's going to be in your offices, and we're going to go into a lot more detail about how to really make money in buy-to-let and how to use these strategies and techniques, and how to make sure that we can go on to assemble a portfolio of any size we want. So whether you just want a few for a pension, or whether you just want a few to supplement your income, or whether you want to be really aggressive and put together a sizable portfolio, it's the same principles apply. And that's what we're going to be going through.
Okay, perfect. Just out of curiosity, how much does it cost?
Well,
or what will you be covering?
Sorry?
What will you be covering?
In terms of the content?
Content, yeah.
Well, let me go through this. we're going to be covering an awful lot, so I'm just going to sort of skim the highlights now as we're running out of time. But I'm going to be going into a lot more detail about why there's a lot more to successful buy-to-let investing than just buying a property. And we're going to be looking in a lot of detail as to how to find the right property, how to decide what it is we want to achieve, and how to set our goals, and how to find the right strategy to achieve all that. Because that's so fundamental to success in property that a lot of people skip over it. But you know, if you leave the foundational stuff out, then it's going to collapse later. So we're going to cover that. I'm also going to be going into a lot more detail on the system which I've used to build my portfolio, and which will allow our listeners to build their own portfolio. And if they build the portfolio with the right properties in, which will allow them to be financially free as well. As I said earlier, it's so important to be buying in a systematic way so that you're in control and you're not being controlled by events. So I'm going to go into a lot of detail of how I put together my portfolio, of which is now 64 properties. And it is very simple. It's just the system. So if I show the system, then there's no reason why anybody can't go out and copy that and do it themselves.
Okay, so who would the course really be for?
Well, first and foremost, it's for anybody who's thinking of getting into buy-to-let, but who hasn't already started. Now would be a great time to come on the course so you can get off to a flying start. It's for anybody who has started, but who's perhaps not finding it quite as easy as they hoped. And maybe they've stalled, or maybe they're just not finding the right deals and they need a bit of a refresher course and a bit more guidance. Or it could be for anybody who's already started and who are reasonably happy with their results, but they'd like to do it better. It's definitely for anybody who'd like to put together a portfolio and who doesn't want to run out of money while they're putting together their portfolio. But what I would say is it's not really aimed at very, very experienced investors who are happy with what they're doing.
Okay.
But if you fall within the first four groups of people, which I'd suggest 90% of us do, then it's definitely going to be for you.
Okay. So you're going to be covering the system, how you put together your portfolio of 64 properties, how to start with with no money of your own, and how you can raise all the finance you need.
Yeah.
Okay. And then you're going to be also talking about the 5 power tools, which all investors should use to increase
that's right. And I'm not talking about Black & Decker. No, I'm talking about some very fundamental things which will really help you to boost the returns from your portfolio. And a lot of investors I come across maybe use one or two, but it's usually sort of through accident or just because that's just the way it happened. Whereas it's good to actually know when you're going in to buy a property the best way to get the maximum returns out of it. And so there's these sort of 5 basic principles which we'll be looking at to make sure that every property is producing as much as you can get out of it.
Okay. So you're also going to be talking about the magic formula that allows you to buy as many properties as you want, which will help achieve their financial goals through buy-to-let.
Absolutely, yeah.
I'm just slightly conscious of time, so we're going to slightly quickly skip through. So normally the cost of, I'm just having a look at this, Peter. Normally it would cost $497, but I'm assuming you're going to do something slightly better than that tonight.
Well, you've been twisting my arm, haven't you? So it's going to be $297. $297 for that day only. Yes.
Okay, so you're going to do it for $297, but more importantly, I've decided to throw in a bit of a bonus.
Well, we both have.
Oh right, okay, yeah, I didn't see this part.
Yeah, so for anybody who books tonight, I will throw in a bonus. I will throw in one of my best-selling ebooks. It's usually $69.97, and it actually takes you through the steps of setting your property goals, finding the strategy, and making a plan to be able to buy those properties, buy the properties you need. So that would be a really good way of supplementing the course, actually.
So you're throwing in that in for free?
I'm going to throw that in for free, yes.
Okay.
But you've agreed to be very generous, haven't you? You're going to throw in something really, really generous.
Yeah, well, as a landlord with 500 properties, 500 tenants, sorry, I've seen all there. I've seen lots of bumps along the way, and it's always I've come up with a USB which has got all the documents which I think anyone who's starting out in property would require. Stuff such as legally binding documents, which not many people think about, but it's actually the most important document that you require, especially when renting out properties. Gas safety documents, guarantor documents. If you go on my website, which is arshellahi.com, you'll expect to pay $197 for that. But if you decide to buy the course this evening, you can have it all, and I'll give you that for free. But now, Peter, can you tell me if someone can't make the workshop, is there something that you can do for them?
Yeah. No, well, you realise that Wolverhampton's in the middle of nowhere, isn't it, Arsh?
It is indeed.
I don't mean that. But there's plenty of people who either won't be able to make that date or who will find it a struggle to travel to Wolverhampton. So what I've decided to do is I will actually put together all the course materials as a workbook and throw in a few other bits and pieces and some other goodies as well. So they've got a complete pack to help them as a reference manual, which they can then use to work through the system and to use to keep them on, get them on track, get them putting together that portfolio for financial freedom.
Okay, and how much are you charging for that? Is it $197?
It is.
So,
it is indeed.
So you'll get all the course material. You get a lot more of your extra goodies. You're getting a copy of your ebook as well as my USB, and you can have that for $197 if you only want the course material. But if you want to come on the course and you want to hear and you want to meet Peter, then it costs $295, and the workshop is being held on the 22nd of March, which is a week on Saturday.
Week on Saturday, yes, in Wolverhampton.
And so if you've liked what you've heard this evening, you can go onto my website, which is arshellahi.com, click on the events page, have a look for Peter. You can also read Peter's biography on there, just so that you can get a bit of confidence that Peter actually knows what he's talking about. Peter is a chartered surveyor, so he knows exactly what he's looking for in a property. He's been valuing properties for how long, Peter?
Well, I've been in the business now for over 30 years, Arsh.
Okay, so he's got a lot of experience in there. So I would urge you to come onto the workshop. Emma's just asked that will we be running this workshop again soon? We're hoping to be running it at least once a month. But what I would suggest, Emma, is that if it's something that's of interest, please sign up and we will get you on a course within the month. Because Peter is talking nationwide at the moment, so I'm assuming we'll have something there where we can help you there. So please go onto the website, which is arshellahi.com. Again, click on the events page, click on Peter's face, and you can buy now and reserve your place. If you are interested in not coming on the course but interested in the documents, please send me a message and I'll show you how you can do that. But on that note, ladies and gentlemen, that brings us to a conclusion of the evening. I apologise that we did have some technical issues. Peter's actually speaking to us via a telephone as opposed to a webinar link because we had a few technical issues there, but I'm hoping that you heard Peter and it all came through in the end. We've had to improvise, which is what we do best. But on that note, I'd like to thank you all very much first of all, for your patience. Second of all, for attending this evening. I know that you could have done a million and one other things. But Peter, would you like to say good night to everyone that's listening?
Yeah, well, as I said, thank you very much for your patience. It's been quite a tricky night for us with the technology, but we've battled through in the end. But I just hope that you had something of value in the content there. But obviously we've had to do this in a very short time, and the technology meant it was even shorter than we were planning. So if you want to take this further, if you want to move your property business forward, then it'd be great to see you in Wolverhampton. Otherwise, I'd love to send you the pack of resources, which will help you as well.
Perfect. And on that note, ladies and gentlemen, I'd like to wish you a enjoyable rest of the evening. If there are any questions, you're more than welcome to email me, which will be arsh@arshellahi.com. Or just send a message through the go to webinar link, and we look forward to speaking to you very soon. Good evening.